Hello, my name is Doug Greenberg, and I'm the president and founder of Pacific Northwest Advisory. On a monthly basis, I put out a very short 5-minute video recapping what's going on in the economy and the markets. Let's get going. Let's chat about something that affects us all, inflation. When you go to the grocery store and it feels like prices are always going up, well, believe it or not, inflation and the speed or pace of inflation is actually on the way down. Not just here in the US, but in Europe and many other places too. This is mostly thanks to things like lower energy prices, fewer hiccups in our supply chains, and a steady increase of interest rates by the big banks. And the effects are starting to show up. You might have noticed that housing prices, which had been skyrocketing, are starting to cool off in some places. Now, I know inflation is still above the Federal Reserve's goal of 2%, but these things take time to fully work their magic throughout the economy. You might have also heard about some recent shakeups in the US banking world, which this could actually slow down our economy a bit as banks might get a little gun shy and cut back on their lending. A bit more on this later. All of these factors together are really changing the game when it comes to interest rates. So keep an eye on this. It affects everything from your grocery bill to your mortgage. The Federal Reserve has a recession model. Think of it as a tool to predict the economy if the economy is headed for a downturn. Right now, it's showing the highest chance of a recession we've ever seen without us actually being in one. Now, this might seem a little like looking up at the sky, seeing the darkest storm cloud you've ever seen, but not feeling a drop of rain. It doesn't mean we're definitely headed for a recession, but it's a bit of a warning sign. This is something that economists and policymakers are keeping a close eye on. It's like they're looking at the radar, waiting to see if that storm is going to hit or pass us by. And it's not a bad idea for us to understand this too, because if that storm does hit, it could have a big impact on things like jobs, savings, and even the cost of living. When we talk about inventories, we're not just chatting about what's stocked up in your local supermarket. It's a much bigger picture than that. Right now, we're seeing inventories across the board at sky high levels. I'm talking factories, warehouses, you name it. They're all packed to the brim. This isn't just one industry either. It's a widespread issue affecting sectors from tech to textiles. Now, why should you care about some overstuffed warehouses? Well, this could spell trouble for our economy. When inventory levels are too high, that often means there's a lagging behind supply. Businesses might have to slash prices to shift their stock, which can eat into profits. Then there's the cash they've tied up in these goods, money that could be invested elsewhere, that certainly carries some level of uh, 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 interest rate payments. Businesses might need to cut costs, and that could mean job losses. So you see, this inventory issue isn't just an isolated problem, it's a domino effect that could hit our economy hard. Even high-end consumer spending intentions are fading. Complicated chart, there's a lot on here, but it's an interesting situation that's unfolding in the market right now, stock market right now. There's this unusual trend where things are getting a bit upside down. See, when the forward earnings per share, meaning when we look out 12 months at potential earnings per share for corporations or the earnings per share growth, takes a dip into the negative, it's usually a sign that companies are bracing for less profit in the future. Normally, the Federal Reserve steps in and lowers interest rates to give the economy a bit of a boost. It's like easing off on the difficulty of a game when the going gets tough, right? But here's the kicker. This time, instead of doing that, they're increasing the rates. It's as if the game's difficulty is being ramped up just when we're already finding it hard to keep up, which is certainly a twist. The leading macro data points to downside in earnings per share surprise over the next several months. And so when you see these forward earnings decline, the Fed is dropping rates, declining, dropping rates. Here we are declining, and rates are ostensibly still going higher. So, when we talk all about this banking stress lately, it's important to understand how it can affect the wider economy. And this is going to be impactful. Basically, when there's a lot of uncertainty and people start withdrawing their deposits from banks, it makes the banks more cautious about lending money because they're lending money based upon those deposits that have been or are now leaving their bank. To get a sense of how this is playing out, we can look at a survey called the Fed's Senior Loan Officer Opinion Survey. The latest survey, conducted in late March and early April, showed that lending standards across the board have become stricter, tighter. This includes loans for businesses, real estate, mortgages, and even consumer loans. Interestingly, this trend started back in 2022 when the Fed began raising interest rates, and it seems to be continuing rather than being a sudden change. Now, the consequence of tighter lending conditions is that businesses and households will likely reduce their spending. We can see this connection by comparing the lending standards for commercial and industrial loans with non residential investment in the GDP data. When lending standards get tighter, non residential investment tends to shrink. So, in a nutshell, tighter lending means less spending by both businesses and households. Tighter lending standards tell us that a credit contraction is coming. Thank you for taking the time to review, and please share with your friends. Thank you.